Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Dave Foster. How you doing today, Dave?
Absolutely awesome. It's great to be here with you, Kirk.
Yeah, glad to have you. So before we begin, Dave, maybe you can tell us a little bit about your background.
Well, I guess trying to sum that up. I'm a degreed accountant with a marketing heart who's bad at numbers. I'm a serial real estate junkie who's spent my life building real estate portfolios, trying to avoid taxes, and along the way, been a father, sailor, and enjoyer of life.
Okay. So, we one of the reasons I want to have you, Dave, on the show is because we get this question a lot on the show about 1031 exchanges, um, Dave, this is something Dave does a lot of. So I wanted to really kind of bring him on to kind of share his experience. So maybe you could tell us a bit about how you got involved with 1031 exchanges.
All right, well, 1031 actually goes way back to the beginning of my real estate investing career. Starts with the first mistake that I ever made. I wish I could say it was the only one, but it was the first one. When my wife and I deciding that we wanted to exit the corporate train and develop a life of independence where we could maximize our time to our advantage. We decided, like so many people have, right, Kirk? Let's become real estate investors. It'll be easy, she said. We'll make a lot of money, he said. And so the next thing you know, ready, fire, aim. I bought a duplex in Denver, Colorado. We fixed it up. We put renters in it. We later sold it. And I thought we are well on our way to buying that sailboat and sailing into the sunset. When my accountant pulled me in and said, wow, you got to write a $30,000 check for taxes this year. And it was at that point that I realized what I hadn't known. And that was that I had a silent partner named Uncle Sam. And he was going to do about as well as I did in this whole deal. So that moment right there, that mistake of not exiting my property sale correctly has really cost me, when I amortize it out today, over $700,000. And plus, it put us behind the eight ball in getting off the corporate train. And that was when I discovered Section 1031, one of the most boring and buried parts of the real estate tax code. But it allows real estate investors to sell investment real estate and then buy investment real estate and get to indefinitely defer paying that tax on the profit in the middle. So the practical impact is you get to take the tax dollars and you get to spend them to build your own portfolio, which is why I'm thinking about all the time, if I still had that 30,000 and had invested that and compounded over the years, what we'd have today. And that was literally the seminal moment when we discovered that. And we started using that for ourselves and for others as well over the years. And it's been a wonderful, joyful ride because we get to help people avoid taxes, build their portfolios. We don't pay a penny in capital gains tax, and life's pretty good.
So, so tell me, when we're talking about, I mean, how many properties have you owned over the years?
Oh my gosh, it's not so much the number, probably 50, 60 properties over the years. Um, it's how you, well, first of all, it's how you buy them. Everybody says that, right? You make money when you buy real estate. But you also, what's equally important is you keep more of your money when you sell real estate. So those 40 or 50 properties bought right and then exited right and allowed to compound are really where we've done it because inherently, Kirk, I'm really kind of a lazy guy and I just hate managing tons and tons of properties. So for myself personally, I'd rather own fewer and have less management issues than to try to stretch myself owning a bunch of the not quite so good ones where it takes more effort to make the money.
So let me ask you, because I know every real estate investor I've ever met, they all kind of look at real estate the same way. Like there's only one asset in the world and it's real estate, and every nickel they ever earn goes back into it. And so it kind of brings up the question, like, why should people do a 1031 anyway? Because you're just going from one piece of real estate to the next. And so why would they ever sell? Like, what's so appealing about this?
Oh, that's an awesome question, actually, and one that we do hear all the time. I tell you what, you want to do a little quiz show here, and we'll talk about the 4 Ds of 1031 investing. And so the first one addresses your question specifically. Why do it if all I'm doing is transferring property to property and I'm only deferring the tax, right?
Hmm.
I'm going to have to pay it anyways. The first D of 1031 investing is to defer for a couple of reasons. Number one, because every day that you defer the tax is a day that you get the impact, the benefit from those dollars. So whether it's 2 years or 30 years, you're making money off the deferred tax. Now, what's that sound like, Kirk? It sounds like a 401k or an IRA, doesn't it? Money's growing, tax deferred. You're making the benefit off of that and the compounding effect. So that's the first D of 1031 investing is to get it started and start enjoying that compound effect. The reason why 1031 fits into that so well is it allows you to go from one type of real estate in one location to another type of real estate in another location. And that really represents the second D, which is defer, because the 1031 exchange allows you to move wherever the market is telling you to. You know, you and I were talking before the show that this isn't the greatest time in a lot of places to buy real estate. It's not the greatest market to access funds. But that doesn't mean there's still not places, sectors, and types of real estate that can be bought and put into service at an advantage. And that's what the 1031 exchange allows you to do. So, for serial real estate investors who think, like you said, that there's only one asset to invest in, defer because you get the compounding, but then defer because you can take advantage of whatever the market cycle is telling you. Is it time to get out of California and its appreciation stalled and go to Austin where appreciation is just starting? Those are the types of decisions that you can make, but you get to do them while continuing to use the compounding effect of those taxes.
Okay.
And that's the first 2 Ds.
All right. So it's interesting you mentioned California because a lot of people are moving out of California and they're selling property to move to other states. Um, how is that working? Because in my experience, California, they got their claws in everything. So,
That they do.
it would be smart to move out of California, especially since it's so expensive and, the demographics are shifting. But, can they still like get their claws in you from a tax perspective? You just, 1031 your property into another state?
Well, there is a clawback provision that you have to file with the franchise tax board every year a form, even when you 1031 exchange out of the state. So you might buy a duplex in Kansas City. Every year you have to report that to California. Now, as long as you own that property, you're never going to have to pay the tax. But if you ever sell that property without doing a 1031 exchange, then California is going to demand that you pay the share of the tax for the profit that they've decided happened while it was in California. So it's called the clawback. It's nasty. Yeah, there's several reasons. I mean, folks are getting out of California because of the taxation. Even if you end up paying some of the California clawback, you want to stop and think about you may be moving from 35 to 40% tax in California total to a tax where all you're going to pay in Texas and Florida would be just federal because there's no state tax. So there's a lot of those types of things aside from the normal motivations to move the property from California. But the key is that the 1031 exchange allows you to do it initially without paying tax.
So let me understand this because this is interesting. So let's say you buy your first property in California, then you move to Texas, and then you move to and then you do a 1031 to Kansas, and you do a 1031 to Maine, for instance. So forget the specifics of so is California the only state that does the clawback, or is every state along that chain? And then after Maine, let's say you sell it and you go to cash. like, do you have to deal with every single state after that, or is it California unique, or how does that work?
Right now, and this is interesting when you think of the geography. Right now, only California, Washington, and I believe Oregon's got a modified aspect of it are doing that. There's other states that are considering it. Why? Because it's cheap and easy money, and every legislator
Right.
would love to get their hands on it. But right now, you could end up with your property in Maine and you sell it. And if you live in California, you've been reporting that all along the way. So yeah, they're going to get it ultimately in Maine when you sell it. Now, what's interesting, Kirk, and there's a lot of bright constitutional lawyers that are just foaming at the mouth to get a hold of this. What if you have moved from California and are living in Maine and you sell that property and California says, hey, we want our tax dollars, and you're not a resident of California, how can they, how are they going to enforce that with you? So there's a lot of questions for down the road as far as really what's going to happen to these kinds of clawbacks. But for right now, they're real, at least in a few of the limited states. And so, we tend to counsel people just beware of that and make sure that it's worth investing there, given what the end game is going to be.
It's funny, Washington, California, and Oregon, all states that are having a migration out of the state.
Coincidence?
Coincidence, I wonder. Um, so maybe you can let's kind of walk it back to the beginning because I want to make sure we kind of cover the basics here. Explain how a 1031 works at kind of a very basic level for like the steps that people have to go through, the things that people have to know to consider this for themselves.
Right. So there is, within the 1031 exchange, there's some very specific tick points that have to be met, but they really do not impact the actual process, just the timing of the process and some of the dollar values of the process. So for an investor doing a 1031 exchange, it is nothing more complicated than you list a property for sale, you get a contract, you sell that property. Now, one of the rules is you can't touch the proceeds. And the qualified intermediary, a third party, has to administer the 1031. So, as part of the closing of that sale, there's someone like us called a qualified intermediary. We document the exchange on the settlement statement, and we have custody of the proceeds in between your sale and your purchase. But for you, you're doing just like normal. It's business as usual. You list, you contract, you sell. Now, at that point, you've got 45 more days to identify your potential replacement properties and a total of 180 days to complete the whole process. So there's some time constraints. But again, you're not doing anything different than going and finding your new property. You're just having to be aware of the timing issues. You find your new property. As long as the property that you purchase is at least as much as the property you sold, and as long as you use all of your proceeds from the sale and the purchase, you'll defer all tax. But for you, your actions are going to be exactly the same. You go and find a property wherever you want in the country, of whatever type you want in the country, that's going to be used for investment. And then you purchase it, the qualified intermediary sends the money into the closing, documents on the settlement statement, and voila, you just deferred all the tax you normally would have had to have paid.
Okay. So just to clarify, so you've got 45 days to once you start, you got 45 days to identify a property, 180 days from the start until completing the process. You have to so let's say you own a property for 100,000. I use this example because it makes it easier to verbalize for the audio part. So you have $100,000, a property worth 100,000. Half of that, 50,000, is equity, and you're going to purchase a new property. So what you're saying is $100,000 or is it out of the proceeds? Is it proceeds minus the expenses? Because I know sometimes at closing there's expenses to close.
Right. So what your audio listeners are going to miss today, Kirk, is me doing math on my fingers because I'm an accountant who's bad at math. But I digress. Um, it's a two-part rule, and the first part of the rule is purchase as much as your net sale, which is going to be your contract price minus closing costs.
Okay.
So again, let's say you sold it for $110,000,
Right.
and there's $10,000 of closing costs. Your net sale is $100,000.
Hmm.
So that's your reinvestment target. Now, there was a $50,000 loan that was paid off. So you're left with $50,000 of cash that goes into your account with the intermediary. You have to use all of that 50,000 in the purchase of at least $100,000 in real estate if you want to defer all tax.
Okay. So you have to use the 50,000 to the new property, and the property value has to be 110,000 or more in order to qualify.
100,000.
Well, I thought you said you're selling for 110 minus closing. So you're saying
Right.
100 minus the closing is the amount you have to put in the minimum.
That
Okay.
is correct. You get to
Got it.
deduct the closing costs. And now there's a key point here that's a great opportunity, and that is it can be property or properties.
Ah,
So it doesn't have to be one for one. You could sell for it, and we're getting into the absurd with amounts, but you could sell for $100,000 and go buy two $50,000 properties. And that's what people who are in growth mode will do an awful lot of. And that speaks to the third D. Want to guess what that is?
why don't you tell me?
Well, the first two were defer. So a safe bet would be also defer. And the reason is because not only will the 1031 exchange accommodate wherever the real estate market is, it will also accommodate wherever you are in your own life cycle as a real estate investor. So the diversification exchange we were just talking about is an example of what people will do when they're in growth mode. They have more energy and time than money. They're starting out. So they sell one, they buy two. And there's a number of reasons why they might do that. Double the rents, double, the appreciations, wherever those properties are speaking to them. And that lets them accommodate when they're in that. Now, you can also go the opposite direction when it's time to slow down and move passive. Then you sell multiple properties and do a consolidation exchange into, say, maybe a larger property where, like a multifamily, where you can grow your portfolio with less on hands management, or into anything more passive, or maybe it's time to start enjoying some of that money. I thought that was really such a neat question when you asked it earlier about, what's the end game in this? All I'm doing is buying real estate. But what you're doing is you're buying cash flow. And with the 1031 exchange, you can also buy, you can at least rent time, quality time, because you can go to a 1031 exchange, buy a vacation rental in the panhandle of Florida, and start to use it some for personal use. That's perfectly fine. The use of a 1031 exchange.
So, all right. So there's actually a few things here I want to touch on. So you can take one property, 1031 into two properties, but you can also take two properties and 1031 into one property, correct?
Exactly.
Okay. All right. That's important to note. Um, but you also said you can use it for personal use. So that's interesting. I thought these were just for investment properties. You can decide to 1031 and then move into it later?
Well, the definition of an investment property is a property in which you have the intent of holding it for productive use in business, trade, or for investment. So, interestingly enough, anywhere in there, it never determines a specific level. And in fact, there's actually a safe harbor from the IRS and its Revenue Procedure 2008-16, which, there you go, I just put half your listeners to sleep. But where if you have minimal use of the property and you have rented it in 2 consecutive years, then they guarantee your investment intent. So there's absolutely nothing wrong with using a vacation rental, some for personal use. As a matter of fact, you want to throw gasoline on that? There's nothing that keeps you from ever converting an investment property into your primary residence.
So
Now, why would
so so basically, let me just cut you off here. So if somebody 1031s a property into another property and it's used at least in part for productive use, either business or investment, which means that you could also use it during that period in time. And then I don't know where that line is, so I'm curious. I'm going to ask you that question: is where that line is for how much is personal versus investment? And then after the 2 years, it can become your primary residence if you want to.
that's exactly right. Here's There's no bright line, so that's the difficulty with this. It's all left somewhat gray, and the reason is because that revenue procedure I cited is a safe harbor. So it's the point where the IRS guarantees it, but it doesn't mean that a period of time less than that or a set of circumstances different than that might not also qualify. So you just got to, it's kind of you
Yeah.
got to feel things out, see what your accountant says, et cetera, et cetera. But here's the safe harbor, and we'll just stay with that for right now because it's juicy enough. If you have rented it for at least 2 weeks a year in 2 consecutive years, if your personal use has been limited to 2 weeks a year or 10% of the number of days it's actually rented, or not counting, and this one I love, not counting any days you lived in the property while it was being improved and worked on, then the IRS guarantees that you, after 2 years, you have satisfied intent. And yes, you can then at that point move into that property, convert it to your primary residence. All of the tax stays deferred as long as you own it. And you actually begin to eliminate a proration of that tax, turning it from tax deferred into tax free because you converted it into your primary residence.
Okay, so that's interesting. So, and effectively, because you get um, okay, so that carries over. So you do get the exclusion if you're married, 500,000 tax free if you live there 2 out of 5 years, right? So is
You
that what you're
get a
talking about?
part of it. Yeah, you get a part of it. And this is where the IRS is going to, they're going to reach out and get some of their skin back. But once you have owned that property for at least 5 years, once you have lived in that property for at least 2 out of the 5 year period, so that sounds familiar, right?
Yep.
To the primary residence rule, then you can sell it and you get to prorate the amount of gain between the period of time it was used for investment and the period of time it was your primary residence. And the period of time it was your primary residence, you get tax free. So here's a great real world example. A client of mine was a realtor on St. Pete Beach. He did a 1031 exchange as he neared retirement, excuse me, and purchased three, I mean, just about identical condos beachfront on St. Pete Beach on the same floor. And after he used the first one for 2 years for investment, he converted it and moved into it. That was the start of his retirement. He lived in it for 3 years and then he sold it. So, had he owned it for 5 years? Yep. Had he lived in it for at least 2 out of the previous 5? Yep. So, he got 3/5 of the gain, 60% of the gain, tax free. And he only had to also recapture the depreciation. But where did he move, Kirk? Next door, and converted that one. Now, that one he's going to live in for quite a while longer. Let's say he lives in it for 15 years. How long has he owned it? 20. How long has he lived in it? 15. So that he can sell that one. He'll get 75% of the gain tax free. Where is he going to move? Next door again. So there is a kind of a series of moves, sort of as you're starting to wind things down, where you can use 1031 and the primary residence exclusion together to start to lessen your tax bill and accommodate your retirement needs. Because almost always people start a general trend of starting out with larger and then ended up downsizing throughout their lives as they go to retirement. It's a great way to do it.
Yeah, it's an interesting strategy. I wonder, with people like that, why they would do it when you could just die with the property and you get a step up. I like the strategy if you need the cash flow, if you need, the capital throughout retirement. But, I think the theme I've seen with a lot of investors is they 1031 until they die, right? And then they just die and there's a step up and they don't have to worry about paying the gains. Like that's the big benefit, right?
And you know what that is? That's the fourth D of 1031 investing.
Hold on, let me guess.
It's not defer.
Oh, it's not? Oh,
No,
wow. It's
you just
shocking.
said it. It's die.
Die.
You nailed it,
Okay.
my friend.
All right. Well,
Yeah, that's the fourth D. So
accidentally I
that
got
fourth
it.
leg is right, hang on to the property. Why will people not do it? Number one, if they're looking for cash flow throughout retirement,
Yeah.
that's certainly a great way to do it. And of course, dying is a great way too, because it gives you legacy wealth that you can pass along. The other reason is if they're trying to accomplish some goals. And this, we actually use this strategy ourselves because we were living in Denver, Colorado, when we got this crazy goal to go buy a sailboat and live on it, sail the oceans. Now, I'm a Kansas farm boy. My wife is from Minneapolis. We're living in Denver. Where's the ocean? We don't know, but it was just a wild air. So we moved our real estate portfolio using 1031 exchanges to position our portfolio ahead of us from Colorado to Connecticut, Connecticut to Florida. And then when we relocated to each of those locations, instead of selling our primary residence and using that money to buy a new primary residence, we took the sales of our primary residences and put them in the buy the boat kitty. And when we moved to Stanford, we moved into and converted one of our investment properties and did that a couple of times and then moved to Florida and converted one of those. So along the way, although we weren't in retirement mode, we were turning tax deferred to tax free to accomplish a goal, which was to buy a boat. And we ended up buying a 53-foot sailboat, moving our 4 children aboard, and having a great 10 years
Nice. Well,
without paying tax.
that's great. So one other question I want to ask, because this has come up a few times, and I appreciate you're kind of diving into this because there's a lot of great use cases here. Um, One thing that's come up in the last 20 years through different firms I've been at, like when I first started out, there was always this concept of DST that people were selling. And the idea was, oh, you can 1031 it into this REIT. Um, and and I was like, oh, what an interesting idea. Because at the time, real estate was really expensive, right? And it was like 2005 and things were crazy. And we all know what happened after that. Which does bring up the obvious question of, well, if I don't like what I'm in, I'm going to 1031 it, like what's safe? Which is a totally different question. But I do want to ask about the DSTs because it has been brought up as an alternate instead of having your own property, right, as an investor, you could 1031 it into some sort of a REIT and we have someone else manage it and it doesn't have to be you. Can you talk a little bit about that, like the pros and cons of something like that?
Yeah, the DST stands for Delaware Statutory Trust. So it's just a specific form of entity, which happens to be a trust formed in, wait for it, Delaware. But the nuance in it is that it has been officially blessed since 2004 by the IRS as a replacement for a 1031 exchange. Now, the reason why that's important is that the 1031 exchange normally requires that you sell actual real estate and you buy actual real estate. If I sell real estate and I buy a stock, I'm not buying real estate. If I sell real estate and buy a REIT, I'm not buying real estate. I'm buying a membership interest in an entity that owns real estate. What about a syndication where a limited partnership owns an office building or multifamily complex? Same thing. I'm not buying real estate, so it doesn't qualify for a 1031 exchange. When I buy a Delaware statutory trust, I'm really not buying real estate either. I'm buying a membership interest in the trust. But the way that it's been structured, the IRS lets you do that and consider that you're buying the real estate. So you're going from active to passive, which is sometimes a very attractive move. You're going from something where you're having to navigate the reefs and shallows of a crazy market into one where you're relying on very experienced and large industry players to navigate with you. So you're buying some experience when you buy the DST, and you're buying continued cash flow while at the same time, and this is there's two things that are most important. The first one is you get all the benefits of real estate ownership, including cash flow, depreciation. That's a big one. You get to continue your depreciation schedules and even buy more depreciation depending on how much you purchase. You're getting the amortization of the loans that are against these. And by the way, these loans are non-recourse to you as the buyer. So you assume your share of them, but you're no longer personally liable for them. And lastly, you're getting all the appreciation. So all of the components of the internal rate of return that make real estate such a juicy investment opportunity are all there when you buy a DST, but you have none of the management headaches. And best of all, I think what I surprised you with when we were talking at the beginning of the show was that because they're seen as a qualified replacement, when that DST sponsor sells that property to a hedge fund or pension fund in 2 or 3 or 4 years, you have the opportunity to 1031 back out. Now, you can go into more DSTs if that's where your head's at. A lot of my investors now are going into DSTs as a defensive move. So they're protecting their cash flow. Where they're anticipating that when the property is sold in, say, a year or two, they're going to be able to 1031 back into bricks and mortar in a more favorable buying environment, post correction, post interest rate reductions, whatever it is.
Interesting. So now do you have to wait for the REIT or the partnership in a syndication? Do you have to wait for that to be sold in order to 1031? Or can you do it any time, assuming that the provider
Well,
allows it?
you're not going to be able to 1031 a REIT or a syndication because you don't own real estate. But a Delaware statutory trust,
I'm sorry.
yes.
Yes.
Yeah. And yeah, they're not liquid. They're just like buying a piece of real estate. And you are at the mercy of whenever the sponsor wants to sell.
Okay.
Typically, they will have life cycles of 3 to 5 years because they're trying to get their performance to a certain point. But generally, yeah, there's no market for you to sell before that. So you do simply wait and hold on and enjoy your cash flow.
Okay, great. No, this has been really, really helpful because that is something that was explained to me differently in the past, but I think this is really good. So Dave, I appreciate you coming on the show. Where can people find more about you?
We created an entire educational website years ago because what we saw was nobody knows 1031 exchanges. It's a crazy small part of the tax code. The IRS isn't going to advertise it. So we created something called the 1031 Investor to help people put themselves into the right position to use these things. And so you can find us at the1031investor.com. Calculators, a YouTube channel, access to us, everything you need to take your investing to the next level by using the tax dollars.
Great. Well, Dave, really appreciate you coming on the show, and thanks again. I'm sure we'll have you back when the real estate market changes tune.
That sounds good.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Dave Foster. Really appreciate him coming on the show. Now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Hi, Kirk. Happy to be here today.
Great to have you. And it's just me and Barb today. Everyone else decided to go on vacation, so good for them, and I guess good for us in a different way. So looking forward to this conversation. So Barb, what were some of your takeaways from the concept of the 1031 exchanges?
Well, the concept sounds one of those too good to be true. Avoid taxes forever. Isn't that wonderful? But there's more to it than that. And the 1031 exchange involves a lot of moving parts, including you have to own individual real estate to begin with, and you have to find that suitable replacement property. And it also raises the question of whether deferring capital gains taxes is always the best move, given that we've got historically unbelievably low capital gains tax rates now. And we don't know what they're going to be in the future.
Yeah, it's actually it's a great point. I think we, you know, there are very few people who actually, I believe, run numbers on these quote unquote rules of thumb. Always defer taxes. Okay, well, there are some reasons for that, right? Like Dave talked about, you can defer them forever until you die, and then there's a step up so you don't pay taxes. Okay, I can buy into that, right? You're finding a solution to not pay taxes. Although it requires your death, which doesn't really help you all that much. But I understand the methodology. But I think when frequently we see these tax strategies, like I'll give you an example. We talk about this a lot, not enough in the show, frankly. But if you compare an IRA to a Roth IRA, most people think the Roth IRA is far superior because it is tax-free. Tax-free. What's better than tax-free? Not much, right? Well, here's what's better than tax-free. Well, let me rephrase that. What is not worse than tax-free is tax-deferred. The IRAs and the Roth IRAs, the traditional and the Roth, are actually identical in almost every single way. And here's the thing. Most people look at Roth, they're like, it's better because it's tax-free. Well, let's do the math really quick. And I'm going to do the math because no one else is doing the math. This is the funny thing, right? People say, oh, well, this is better. Okay, show me. And at one point, I decided to do the math because I talked to somebody and they're like, and they mentioned this. I'm like, really? Like, that doesn't, like, that's interesting. So I ran the math and realized that they're identical. So here's what you do. And you can do this at home, all you home gamers. Do this at home. And if you're not, let me know and I'll send you a quick spreadsheet. Take on one side the traditional IRA, on the other side the Roth IRA. Let's say you start with $10,000, $10,000 in the traditional, $10,000 in the Roth. Okay, so you earn 10,000. Now I know the numbers aren't lining up because you can't put 10,000 to an IRA. So just use this example because I'm trying to make the numbers easy. I think the numbers are like 7,000 this year is what you can contribute. But let's use 10. Okay, so you can contributing 10,000 to a traditional, and you earn 10,000. So if you put 10,000 into a traditional, that's pre-tax. So there's no tax taken out. You can put in the whole 10,000. But the Roth is after tax. So technically you're taking out taxes. Let's call it 30%. So you're really putting in 7,000 into the Roth. Now immediately you're already at a deficit, right? You're 30% less. So you got to make that up. So over the next 20 years, let's say that 10,000 in a traditional grows to 100,000. And the 7,000 in the Roth IRA grows to 70,000. You know, same kind of ratios, right? Now at the end, you got to take your money out. So let's just make it simple and say you take all your money out at the end at one time. Well, the traditional IRA, you got to pay tax at 30%, which means now you've got 70,000. The Roth IRA is already at 70,000. You don't pay taxes, so it's the same. It's identical. Most people don't realize this. And they'll say, well, I know, but I put my best investments into a Roth. Now, my response is, really? What are the best investments? Please let me know. I would love to know what the best investments over the next 20 years is going to be. And I'll hire you to be my investment advisor. Nobody knows. That's the whole point. You don't know what's going to be the best investment in the next 20 years. So how can you say, I'm going to put the best ones in the Roth? Now, you might put the most volatile ones. You might decide, oh, I'm going to put all it in Bitcoin. Okay, well, I can make that argument. Yeah, you're taking a shot. Maybe it goes up 100x, maybe it goes down to 0. But I'm not going to argue it's not the most volatile thing on this planet, because it is. So you could make that distinction, say, all right, but it could easily go to 0. So you can't say it's a sure thing. So you can't guarantee returns, and you don't know what it's going to be. So realistically, you can't predict returns. So you can't say you're going to put the best stuff in a Roth. You can't, bias it that way, which is how people make the argument. And the other thing is also you don't know the tax rates. You don't know what the tax rates are going to be, because most people say, well, I'm going to put it in because it's tax-free and the tax rates are going up. You know how long I've heard that? My entire career. For 25 years, I've heard people saying, oh, well, tax rates are going to go up, so I'm going to use the Roth. Naturally, I don't want to pay more taxes later because they have to go up, right? All this money the government's printing, they have to go up. You know what's happened in the last 20 years? Tax rates have gone down. They're lower through different administrations, through different political parties. It's gone lower, right? And yet we think it's going to keep going higher. No, I'm not going to argue that it's not, because it should go higher, but I don't think it will, because the government knows we can't afford it. So they want to get reelected, and so they're not going to raise taxes. So I think that there's a very low probability that tax rates are going to go up very much. Now, it doesn't mean fees aren't going up, because fees definitely are going up, but the actual tax rate is definitely probably going to stay around the same. So let's assume for the moment that tax rates are going to be the same. So how do you decide? Well, actually, there's only one factor that you can determine. And here's the factor. How much money are you making at the time you contribute? Now, if you're just out of college, you get your first job and you're making 25K or whatever it is, then you should max out your Roth IRA, because you're at the lowest tax rate. So if you're making, let's say you're making 10,000 and you put the whole 10,000 in, for the sake of this example, I know those numbers are weird, but let's say you put the whole 10,000 into your Roth, and your tax rate is like 15%. Okay, great. Well, you put in you basically paid 15% and you take it out tax free. So more of that 10,000 is going in. You got 8,500 going in. But let's say you're making $500,000 a year. Well, your tax rate's going to be higher, right? It's going to be like 30% plus. So instead, you're putting in 70. So the best time to put money into a Roth is when you're at a low tax rate. Fresh out of college, you don't have a job for a year, whatever it is, but you have a low tax rate. That's the best time to contribute to a Roth. If you're making a ton of money, do not put money into a Roth, because you're not getting the benefit. Put it into a traditional, and you can defer it as long as possible. And the probability is such that most likely when you retire, you will be at a lower tax rate than the highest. If you're at the highest tax rate, you can only go down. So contribute to a traditional, defer it, and at your retirement, hopefully your rate's lower. You don't know if it is, but most likely it's not going to be that much higher. So that's the strategy. It's a quick tip here, but that's the strategy. But most people have never run that math. And they just assume the Roth's better. And they don't know because someone else told them and someone else told them, and no one's really done the work. But if you've done the work like we have, you know that they're identical. And the only strategy is tax rate going in, tax rate going out. So that looks at real estate the same way. So Barb, you've been a lifelong real estate investor. How do you look at taxes when it comes to real estate? Because real estate's one of the best assets on the planet when it comes to tax benefits. So how do you look at it this way?
Yeah, I was brought up looking for the legal tax breaks. That was my thing. Even if you have a small side gig that doesn't make a lot of money, you can write off so many expenses that it is a net positive. So tax breaks matter, and many tax breaks are not tax deferrals like you have with a traditional IRA. Eventually you're going to pay tax on that money when it's withdrawn. No bones about it, the traditional IRA. Real estate has a lot of tax breaks, including you can write off all your expenses. You can depreciate the asset. You can not pay any taxes until the property is sold, and then it's taxed as a capital gain after depreciation, which is a huge tax benefit. And like I said at the intro, capital gains rates are so low, and they're so much lower than ordinary income tax rates, that I really wouldn't even pay that much attention to them, because like Kirk said, you can delay with a 1031, you can delay your capital gains taxes till you're dead. Well, then you're dead. What difference does it make? So real estate has so many benefits if you're an individual owning individual, a rental property, a duplex, an apartment complex, whatever. But it also has some huge downsides, which is getting that call in the middle of the night. Fix my furnace. I have bugs. This broke, that broke, the other broke. Oh, I have to move out tomorrow. And so those problems make real estate not a passive activity. Real estate investing is extremely, extremely active. And don't think you can hire a manager, because managers have to be managed. And I have been through so many real estate managers, and they don't do it for you. You have to spend as much time overseeing them as literally they're doing the work on the property. So that said, if you want to be hands-on, real estate is an amazing investment. You can really build up a very nice portfolio. And over time, just like with stock investments, likelihood that the property will appreciate. You can also get a really nice cash flow, because as you pay off the mortgage on the property, that means your expenses will go down and your rents will go up, so your cash flow will grow. So that's a plus for hands-on real estate investors. But there are also other ways to tap real estate: through REITs, real estate investment trusts, through private real estate investing. And although not everyone agrees with me, I think real estate deserves a place in most investors' portfolios.
So I'm curious because you invested in physical real estate, and certainly, there are different ways to invest in real estate. And I think a lot of people miss this. They look at REITs and they say, oh, real estate, let's invest in REITs. And certainly sometimes it makes sense, sometimes it doesn't, but they're very interest rate sensitive. And I think most people miss that. They just say, oh, well, I'm investing in this thing and it gets me, like 8% or whatever it is. And it's like, well, maybe, but what if they cut their dividend? Then you're not getting 8%. And then the next question is, well, if it's 8%, why is it 8%? Is it possible that it's 8% because people don't truly believe that the dividend won't be cut, right? If dividends are 5% across the board and this one's 10, it's either high risk or the market's missing it. and the likelihood is the market's probably not missing it, right?
And also, don't forget how real estates are required by law to pay out 90% of their earnings to the shareholders. And the tax treatment of REITs is that it's taxed as ordinary income. So that's a big negative for owning REITs. But if you own a REIT in an IRA, then you're not paying tax on that income. So I know this is a little kind of nuanced, but REITs can be really beneficial if you're owning them in an IRA. And what Kirk said is right. Whenever you're getting a higher than market interest rates, something's going on. You're taking a bigger risk. It doesn't mean you shouldn't go for higher yield fixed income assets, but your default risk is going to be greater, and there are other negatives built within that investment, that the reason being that they have to pay the higher interest rate to get you to invest in what is going to be a riskier asset.
Yeah, I'm going to give I'm going to give another mental model today. I feel like everyone's getting pure gold in this episode. I'm gonna share something because this came up yesterday, and it's not real estate related, but I think it'll help, and it has to do with taxes. Now, here's a question, and I'll use Barb as my guinea pig here. So let's say you got a stock. I'm just gonna make up a name. We'll call it Pear, and Pear is one of the larger companies in the world, and everyone loves it, and it's got a lot of growth. And yet, let's say at one point in time, Pear stops having exponential growth. Now, the question is, does it make sense to sell your shares of Pear? And let's say your cost basis is close to zero. Does it make sense to sell it and pay the 20% capital gains tax and reinvest that into something else? Or do you just hold on forever because you don't want to pay the tax? What do you think, Barb? How can we think about this scenario?
This is reminding me, because as many of you know, I've been investing in the financial markets for close to 40 years. And initially I was a stock picker and a very deep value investor. So I'd buy stocks that were selling for less than their intrinsic value, and I'd hold them as long as I thought they would be a fair value, and then I'd sell them. Well, many of the stocks that I have sold, such as Microsoft, these are not in my portfolio now, Microsoft, Walmart, Oracle, I think I might have even known Intel at one point. I'm very sorry I sold those. I wish I had held those indefinitely. So you cannot let taxes drive your investment decisions. You want to let the investment drive the decision. Do you think this is going to be a good investment going forward? And then if you do, hang on to it. If you don't, if you think the growth is not there, and if it may be overvalued now, but maybe the valuation will catch up with you. So I don't look at the taxes when I'm selling a stock. I look at whether it is a good investment. And then that's just the perspective. And I have to share another one that is just killing me, because I bought Coinbase. It fell. I sold it because the prospects didn't look good. And now it's like tripled since I sold it. And so again, clearly not all my decisions have been like this. I am holding a couple of issues that I've held for a long time that have given me very nice returns. But if you are a stock picker, or even if you're a trader of any sort, make your decisions based on whether you believe the investment will give you the return that you're looking for going forward. Don't look at the past except to use it as kind of trend data. But just because a stock has been a high flyer in the past doesn't mean it's going to continue that way.
Yeah, I think it's great to think about that because I think we all kind of get stuck in this. We kind of get stuck in this rut of we own a stock, we don't want to sell it because we don't pay the taxes. And yes, there are companies that we all wish we didn't sell. Um, but there are times, and I think we used on the live episode, we used Cisco as an example, not to point out that they're a bad company or a good company, but rather just the history of it. And if you look in the late 90s, it was one of the high flyers and it skyrocketed and it still hasn't eclipsed its former peak. And that really doesn't have much to do with the company's prospects in the future. What it has to do with is the fact that people way overpaid in the late 90s. And so when you way overpay for something and then the trends soften, let's say, they don't have to reverse. I mean, because obviously people are using the internet and people are using Cisco and they're still a viable company. But when you pay, I forget what it was at the time, it was over like 100 times earnings. I think at the time it was like 100, 200 or some crazy number. Um, if you're 200 times earnings, that means it's going to take you 200 years to have earnings to recover what you paid for your shares. That's crazy, right? 200 years, that means you're never going to make money in that stock. Now, there are some stocks out there right now that have really high PEs, and you could argue that their growth is going to eclipse that. And I think that's the argument that growth investors make is that, well, yeah, the P is at 70, but they're going to grow it like, whatever. They're going to grow 70% this year. Okay, well, I mean, if that's the argument you want to make, that's fine. You don't know that, but I understand. So if you're looking at, a company like Pear, and let's say you assume that, well, they don't have positive outgrowth in the next few years. Okay, well, I'm sure a lot of other companies do. So the real question is, do you want to sit on dead money for a while? Would you rather pay 20% in taxes, take that cash, reinvest into other things that in the next few years will outperform this other company you're looking at? And that's a real question you should ask yourself. And I think a lot of us get caught into the, oh, I've owned it for so long and it's done so well for me, so I should never sell it. Okay, but at some point you have to pay taxes. Is it today? It comes back to the IRA question. Do you pay taxes today or do you pay taxes 20 years from now? It doesn't matter. You still have to pay 20% in taxes. The question is, what is the best methodology to actually grow that money? Now, if you didn't have to pay taxes, hallelujah, right? Do that in your IRA and you don't have to worry about it. But if you do, yes, you have to pay taxes unless you have to invest. But if I'm invested in stock A and I have to pay 20% in taxes and it goes nowhere for 5 years versus scenario B or same stock with scenario B, and you sell it, you pay the taxes and you can invest in something that goes up like 50% and this other one, the scenario A goes sideways. Well, you've overcome the 20% barrier that you had to sell. And the idea is you're investing in things that are making you money. And I always look at taxes as taxes are always second place. Taxes are all right, we're going to make a decision. All right, now we look at the taxes and see if there's something we can do. But most people look at the taxes first. Well, I don't want to pay the taxes. Well, that's not a decision. That just means you don't want to pay taxes. It has nothing to do with your investment. So taxes are something you nuance after you make the decision. Oh, I'm going to sell my company. Okay, well, you're going to pay a lot of taxes. Okay, great. Well, how am I going to shield some of my taxes or defer them or whatever you want to do? Well, then there are strategies to do that. Like we do some of that with our clients. We do some advanced tax planning on people selling their business. So there are many ways to do that. But it doesn't affect whether you're going to sell your business or not. You don't say, oh, really? I got to pay taxes on selling my business? Forget it. I'm going to keep working, 100 hours a week in my job because I don't want to pay taxes. I mean, think of how silly that sounds. When you're done, you're selling, you're done. Like you're not going back and be like, well, I guess I'll keep working hard instead of paying the government. I mean, that's just silly. So you got to think of your passive investments the same way. How do you manage that process is really important. And this is you know, why Barb and I are talking about this in the tax aspect. I mean, 1031s, you know, should you defer or not? I don't know. So here's a question. I mean, Barb, I know you've invested in real estate a long time, and I want to get your real estate investor hat on here to think about how you used to think about it. But I remember back in 2008 where I was talking to some friends, and they were saying they were 1031ing their real estate um, into like Walgreens and CVS triple net leases. And I guess it was a thing because you could get 5 or 6% from them, and I'm not going to say they're guaranteed, but in the real estate world, they were perceived by many investors as kind of like a guaranteed income stream that wasn't going to go bankrupt or wasn't going to get foreclosed or all the stuff that was going on in real estate. It was a very clean and understandable investment. And they 1031 in so they can get out of the garbage, and then they would 1031 it out at a later time into a new property. But they were seen as more like the plain vanilla stable investment that they could hide in temporarily. Now, when you're buying real estate, like were you just kind of buying and saying we're going to hold this forever? Or was there like a greater strategy, or how did you guys think about that when you're investing in real estate?
Well, it varied. For example, buying small properties to rent out, there was the idea that you keep the property for the cash flow indefinitely, as long as that was working. For me personally and my husband, when it got to the point where we were fed up with the work that was required, and we both had other jobs as well. We weren't full-time real estate people, but when we found the management just got too much, that was like, okay, we need to transition out of this. The potential benefits weren't worth the cost to us. Now, when I was head of the financial portfolio manager for a real estate holding company, now our company would buy real estate in bulk. We would fix it up. We would resell it. We also owned some apartment buildings. But our strategy was buy undervalued homes, put some money into them, and resell them. That was our strategy. With the apartment buildings, well, we'd use those, we'd buy those for the cash flow and for the appreciation potential. And we kept them until we sold the business. When we were, like you said, we were done. We sold the business and we sold the properties. So for me, it's like, determine what your goals are. There's not a right way or a wrong way. If you want to be a real estate investor in some areas of the country, now I live in California, I wouldn't be a real estate investor here under any circumstances because the costs are so high. If I was geographically mobile, I'd be a real estate investor in Detroit. Detroit is coming back. You can buy a house for like $50,000. You can put $30,000 in. You can sell it for $150,000, and you've, almost tripled your money in 6 months. So if that were, something that I was really interested in, I would do that today. Look for the pockets where there's value to be made. And I do not ascribe to these ideas that you buy a property with the hopes of it appreciating, because that's an unknown. So I know some people do, and that's a different philosophy, but I believe you buy a property where there's room for value. So maybe you can improve the property and increase the rents. Or maybe you can make some repairs and increase the rents. But these are all hands-on strategies, and they are developed, or they are available to people who want to do the work. And I think real estate's an amazing industry. For the rest of us that want to tap in, you've got private investments, you've got REITs, you've got partnerships, that sort of thing. And those are a different animal because you're paying someone to do the work, and you're paying fees, and you've got to trust whoever's managing that property. And that is why I'm always skeptical of syndications and private real estate investing, because someone's getting rich. And frequently it's the people that have put the syndications together. And when I go into an investment, I want to be the one getting rich.
Yeah, and you know, you mentioned syndicates, and it's interesting because I came across this the other day for a call I had, and somebody had invested in a syndicate, and the person who was running the syndicate had a great track record, you know, like 20, 40 years. I forget what it was offhand, but it was decades, and great track record, no issues, all through 2008, all of it. And um, they had their first capital call. So they reached out to the investors and said, "Hey, we need to pay down the debt." And this was commercial real estate. They're like, "Hey, we need to buy down the debt. We've got our loan is coming due. We have to roll it over, and the cash flow is going to be a lot less because we have higher rates." I think there was even negative cash flows from that. And they said, "You know, we need to raise capital. We would really love it if you contributed, if you double your capital investment so we can pay down the debt." And my first thought is, hell no. That's just a terrible idea. If anyone asks you for more money after you've already given them some, and their answer is basically, "Sorry, things didn't go as according to plan. I need more money." The answer should almost always be no. Obviously, it depends on the investment, but my answer is typically always no, because if you didn't do it right the first time, then more cash is not going to make it better. Now, this person may have been very smart. They've been very may well have been successful as a real estate investor, but these cycles happen, and they do happen. They are cycles. There are good times and bad times, and there are a lot of people caught short. I think New York City Bank Corp. I think that's the one that's getting creamed today and yesterday because bad earnings, and you know they have a lot of New York office space and commercial property, which is part of it. And look, we're in a real estate cycle that's not going to be very forgiving to a lot of firms. And New York City Bank Corp actually was one of the firms that took parts of Signature Bank. So I don't have all the details. I'm just going by the headline news. So don't take this as advice one way or the other, but just that's what's coming out. But basically, if you look at real estate investments now, especially syndicates, you're locked in. I am getting bombarded with cold calls, emails from everybody. "Oh, we've got this project," and it's not an original project. It's like basically somebody else trying to get out of their shares. Don't ever do that. If someone else is getting out of theirs, don't buy it, because it means someone else is smarter than you and they're seeing something you're not seeing. Now, you can't always get out of syndicates, but if you can, it might be worth considering, because right now the real estate markets are frozen in many parts of the country, in many, you know, sectors, and you should be wary of that and not be so eager to jump in because the real estate market goes down 1% or 2% and says, "Oh, look at this bargain." Just be mindful of the fact that there are cycles, and we may be at a turning point in the cycle. Who knows? If interest rates go down to zero, we're off to the races again, I'm sure. But just be mindful of that. And when you're looking at deals, don't always get hoodwinked into, "Oh, here's what we propose as the IRR for the project," and it may happen, it may not, but no one's ever going to say, "Oh, our IRR is probably going to be 1%. You should really invest in this." There's no way. Even if it was, they wouldn't tell you that. They'd find a way to make it 10 or 12 or whatever it is. So just be mindful of projects. Do your diligence, do your homework on the people and the projects. And right now, just be cautious, because if you're investing in real estate, whether it's a syndicate or a one-off property, it's not easily saleable. And at least a one-off property you can sell. Syndicates a lot harder. So just be mindful of what you're buying into and where we are in the cycle. So Barb,
Well, and the key is, Kirk, we are at the highest interest rate level we've been at probably since the start of the millennium. And that means the cost of capital is much higher. So you could get a commercial loan maybe for 4 or 5%. A couple of years ago, now you're paying 10%. What does that mean? Your debt costs have doubled. And so what does that do to your profits? Your profits have gone down. So you have to understand those sorts of things and decide if the numbers make sense. And particularly if you're looking at syndicates like Kirk mentioned, are they factoring in the right interest rate? Because if they're factoring in their numbers based on a 5% interest rate and interest rates are 10% for new debt, well, then your profits are going to go way down.
Yeah. Yeah, just be mindful of all this. I think we all go in with a, hey, we're going to make lots of money mentality, and most people don't think about risk first. Where can I lose money? How can I lose money? What's going on in the trends? What's going on in the industry? What's going on in the area? What's going on in this property? You should be looking at all those things. If you're just looking at the email they send you or the prospectus they send you and saying, oh, this looks good, then you're only seeing half the picture, because they've done their diligence to put together a marketing package to sell you on why you should give them your money. They're not doing diligence for you. That's your job. If you're buying into physical real estate or other non-traditional assets, your job, actually any investment, but really more the physical stuff that you cannot liquidate as easily, you got to do your homework. Don't expect someone else to do it for you. No one else is going to do it for you. You have to do it yourself. You work with an investment advisor, they might do it for you, but certainly the person selling you on the property is not going to do the diligence for you. They're going to make it look like sunshine and roses. And they might be right, but their job is not to make themselves look bad. So you have to be the one to do that. You have to go in and tear it apart and deep water test all of it. And if you come out smelling like roses, great, invest in it. But most likely you're going to find some other stuff and you may decide you don't want to do it. There's not a lack of deals out there, but there is a lack of good deals. So just because you see 100 deals doesn't mean that any of them are any good. Now, historically, you probably find one, but out of 100, but generally speaking, you're not going to find as many as before. So just be mindful and don't be in a rush to put all your money to work. Some people are just in a rush. Like, I got cash sitting in the bank account, burn a hole in my pocket. Like, okay, we'll put it in treasuries or CDs for 3 months, earning 5%. Well, it burns a hole in your pocket. I mean, 5% is pretty good. And just wait for a good deal. Don't be in a rush. Don't, if you don't have a plan in place, then you can get yourself into trouble. So have a plan and don't worry about cash sitting around. Put it in money market, treasuries, CDs, whatever it is, short term, till you find a deal, and then put it to work. But just don't be in a rush, because I think too many people are in a rush. They got FOMO, all the stuff that investors have, and that's how people lose money. So just be careful out there. Barb, final thoughts from you as we wrap it up.
Whenever you go into any type of investing scheme or strategy or approach, understand what is your part in the opportunity. If you're doing a 1031, you better really know what you have to gain, what the losses are, how complex this situation is, can you get out of it, and are the tax breaks really appropriate for you, or are they really less of an issue than is being sold to you? When you're looking at other types of opportunities, do your due diligence. Always question the assumptions that are being made by the providers. So be smart when investing, be patient. I love what Kirk said. Don't ever let the money burn a hole in your pocket. You're better off sitting on cash for a while than jumping into a losing deal and watch 20, 30, 40% of your investment go down the toilet. I'm Barbara Friedberg. You can find me on YouTube and at Barbara Friedberg Personal Finance.
Great. Well, thanks for joining me on the show, Barb. Just once again, just me and you having a good time here for the listeners. So thanks for joining us. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.